Shares of Newell Brands are looking at losses of just about 27%, have been off about 29% in earlier trading. You're looking at the biggest drop that we've seen since 2008. This comes on the heels of the earnings results that we got from the company. Now, if you're not familiar, they're the maker of Sharpie, Rubbermaid, some other consumer-related products here. Now, the move lower coming on the heels of the guidance update that we're getting from the company, disappointing annual outlook. Let's talk about this and more, especially as the threat of tariff looms. And for that, we want to bring in Chris Peterson. He is the CEO and president of Newell Brands. Chris, it's great to have you back here on Yahoo Finance. Your stock's been halted a couple times here this morning on the heels of the outlook, the preliminary outlook, looking to spook investors just a bit. Explain to us what's going on right now and the decline that we could potentially see here this year.
Yeah, frankly, we're a little bit surprised. It's good to be with you. But we just reported a fourth quarter that was very much in line or ahead of our guidance range for Q4. We provided initial guidance for 2025, and our initial guidance includes core sales growth improving in 25 versus 24, strong operating margin improvement, good cash flow, and strengthening of the balance sheet. We think we're making progress on the turnaround. We think that the priorities that we've established, we're continuing to do well with. And our guidance range for 25 was fairly close to what the street was expecting from a consensus estimate standpoint.
Does this factor in? I don't believe it does. Does it factor in the impact of tariffs?
It does not factor in the impact of tariffs.
So,
That's
Chris,
correct.
what does that look like then potentially?
Yeah. So on the impact of tariffs, what we said was that there's some things where we think we've got significant opportunities as a result of tariffs, and there's some areas where we think there's some challenges. So let me start by saying that about half of our business we manufacture ourselves in our manufacturing footprint. The largest part of our U.S. business is manufactured in the United States, and we believe that if tariffs go into effect on those categories where we have U.S. manufacturing presence, we will be competitively advantaged. We are already starting to talk to retailers about shifting promotions, shifting shelf space to some of our U.S. Manufactured product categories, and we think that's a tailwind for us. At the same time, we have some business that we are sourcing from outside the U.S. where we have potential tariff headwinds. Particularly on China, we've been working over the last several years to reduce our exposure to China manufacturing. Several years ago, about 35% of our business was imported from China to the U.S. That, as of today, is down to about 15%. And we expect that 15% of imports from China to the U.S. to be at 10% by the end of this year. Likewise, from Mexico, we think imports from Mexico represent about 5% of our cost of goods sold base, but we think we've got optionality in our supply chain and through productivity and pricing initiatives to largely offset that impact. So we think we've got opportunity in some of our businesses for tailwinds and some of our businesses for headwinds. It's too hard to predict at this moment what the net of that is. And so relative to the guidance that we shared this morning, we said that we did not guess where U.S. trade policy was going to land. We provided guidance without assuming any positive or negative from tariffs.
What does that tell us then about the timing just in terms of getting back to that top line growth?
So what we've said is this year, our guidance for core sales growth is -2% to +1% for 2025. And we expect in the first half of the year to be down low single digits. We expect in the back half of 2025 for the company to return to core sales growth. Importantly, we've returned our most profitable segment, which is our learning and development segment, already to core sales growth during 2024. We've returned our international business in total, which is about 40% of our business, to core sales growth. And we expect those two businesses to continue. Our home and commercial segment, which is our second largest segment from a profit standpoint, we expect to return to core sales growth in the back half of this year. And then the outdoor and rec segment, which is our smallest segment, we expect to return to core sales growth in 2026.
All right, Chris Peterson, we always appreciate you taking the time. Thanks so much for joining us here, CEO of Newell Brands.